All right. Good morning, everybody. Today is Wednesday, the 25th of May. Ben, how are you? You came in here at the last minute.
It was at the buzzer. I was actually doing a channel check of the company that we're about to talk about. So good stuff there.
Okay. So this morning we have more bad news in the tech world. Lyft is the latest to have significant slow hiring and cut costs. In addition, the management plans to give eligible team members new stock options and make up for declines in the company's stock price. This gets to another issue. People have been compensated in stock-based, people have had stock-based compensation, and that's been generally very lucrative. But because of the stock price falling, sometimes 80%, that does not bode well for their net worth. And so today, Lyft is at what, $16?
$16 share.
Ben, you have anything else to add on that?
Yeah, so it was $75 in 2019. You see in Silicon Valley, a lot of these people get paid in stock-based compensation, which is great. So everyone loves to have ownership of their company when the company's going up in value. But when the company goes down in value significantly, all of a sudden you have a lot less retirement. You start to get a little bit nervous, and that's a negative wealth effect. So when we're talking about the wealth effect, it's not just crypto going down in value or 401ks going down in value, but it's also these people's stock-based compensation. And these are true believers. They work at the company, they believe in the company, and now it's worth 20% of what it was. So that's bad news. We were talking before the show in about 30 seconds was Apple had some bad news as well. It looks like, according to some reports, that they're talking about delaying the new launch of the new iPhone because of the supply chain issues in China. So we knew that they were going to have a $4 to $8 billion hit because of the iPhone issues this quarter, but we're also now seeing that there may be an impact for the next launch of the new iPhone. Elsewhere, away from Techland, or even staying in Techland, one of the things that I'm positive on, Jonathan, is the market actually rallied yesterday. It was down 2% at one point on the heels of Snap we talked about on the call yesterday. It was down 43% yesterday. Facebook was still down 7.5% for the day, but it had been down 10% at one point. Google was still down 5%, but it had been down almost 8%. The big takeaway here, though, is the market only fell 0.8%. And actually, there was net buying on the day. When I say net buying, it means that the stock market opened lower than when it closed, which means during the day's trading session, people actually bought. So it was really just a move in the futures that marked down markets yesterday. So that's good news. It means that people are actually, real money is coming into the market to buy. So that's good news on that front.
Quick question about Snapchat.
Yeah.
How are they on ad revenue? I feel like whenever I get on Snapchat, I get sucked in by this little stories they have, and there's always a 5-10 second ad. Feels like every 20-30 seconds.
So I think the issue with Snapchat is they are seeing less demand for that product. So it's done on an auction bidding system. So this is not necessarily related to users, in my opinion. This is related. All they did was say that revenue was going to come in lower than expected, and earnings were going to come in lower than expected. They didn't give a number on it. They just said that it's going to be bad. I think the primary reason for that is the fact that they're not getting as much demand for their platform. Why aren't they getting demand for their platform? Because all those mobile app games, all these small companies, these venture capital funded companies that have these new products. Again, we talked about the products that are not in the center aisle, those knickknacks that you might pick up as you go into a grocery store or come out of a grocery store. You see an ad for on Instagram that you've never heard of before, but you want to buy it. That stuff isn't selling anymore because people are more budget conscious. If it's not selling, those guys aren't advertising, and you're not having those bidding wars for ad space in Snapchat.
Makes sense.
I think that's kind of what we're going to be seeing on Facebook as well.
Yeah.
In other news, one of the things that really surprised me yesterday evening was Nordstrom. Nordstrom got up about 10%. This retailer has been really poorly managed for a few years now. They may actually be getting on the right side of things for once. What's notable here is that Nordstrom actually raised guidance for the year. This is the first retailer first major retailer that I'm aware of that has actually significantly raised guidance for the year, both on revenue and margin. So they are continuing to see higher freight and material costs, but they had such a strong first quarter that they actually raised revenue guidance, which helped their overall margin profile as well. They said shoes were strong, up double digits. Men's apparel was actually the strongest category. I guess maybe people going back to work. And they also said that men's and women's apparel was driven especially by suiting and dresses. So maybe also, people going back to church, people going to weddings, things like that. Things that you do, more formal events that you attend when things open up. So Nordstrom is benefiting from that, and they're actually, for once, able to execute on that. Importantly, they say we haven't seen an adverse impact on consumer spending from inflationary pressures, which we suspect is due to the higher income profile of our customer base. We do continue to see macro-related cost pressure and labor fulfillment. So basically, they're attributing their strength to the fact that their customers make a lot of money and aren't being impacted as much by inflation. Now, the question is, will they be impacted by the wealth effect as the stocks decline and all these things decline? So that's a question going forward. Best Buy was a good news in retail. So there has been some good news. Intuit was good news this morning. Intuit, interestingly, was really driven by their acquired business, Credit Karma. Credit Karma was guided up for the year from $1.5 billion to about $1.8 billion as more people take on loans, which I think the loan acceleration has happened a lot faster than people expected, because it took forever and then it happened all at once, which has been good for the banks. It helped JP Morgan and its net interest income, and it's helping Intuit as well. The question is, right now, credit quality remains really good. But the question is, if these loans continue to accelerate at this pace, are they going to continue?
And I think you mentioned this the other day. We both have American Express, and they're sending emails trying to get you to take out a loan.
Yeah, they're really trying to get loans out there for sure. We have Toll Brothers coming out. Toll Brothers, the big home builder that came out last night. Again, these are all these companies that have an off-cycle earnings report where the quarter finishes in April. So we have a month of that week period to actually digest results. And Toll Brothers said that things did weaken in April. Having said that, they continue to sell homes at exceptional prices. The average home price is up 15.6% on a year-over-year basis. The backlog is up, the margin is up, and cancellations are actually down from last year. Cancellations as a percentage of signed contracts in the quarter were 3.8%. That was down from 4% on a year ago basis. They did take down guidance for the year, primarily related to supply chain issues, but their gross margin was reiterated and revenue was reiterated. Revenue was reiterated despite the fact that home deliveries are actually going to be down versus their prior guidance, which means that price is making up for that lack of volume. They say that while demand is solid over the past month, it is moderated from the unprecedented pace of the past 2 years as buyers adapt to higher mortgage rates and other macroeconomic conditions. However, the many fundamental drivers of housing demand remain firmly in place. These include favorable demographics, the significant imbalance between the supply and demand for homes, and migration trends. These are things that we've talked about. I think that this is a good number, but I don't think it's going to change the narrative, because the narrative of pricing and unit slowing is still the narrative. And ultimately, I think that's going to be the narrative throughout. You see Nordstrom being a little bit of an anomaly, but in general, I think what we're going to see is pricing up, units going down, whether you're talking about automobiles, whether you're talking about homes, whether you're talking about apparel, whether you're talking about Nike shoes. We'll get Nike at the end of June. I think that'll be a trend that we see persist throughout the earnings reports. Spare a thought for Dick's really quick. Dick's Sporting Goods reported earnings today. They're down about 15% pre-market. The sporting goods retail, they took down guidance. They actually had a really good quarter, but they took down guidance for the year. Revenue down 2 to 8%. The estimate was for just down 2.5% for the year. So they do expect that inflation and some of these macroeconomic factors are going to negatively impact results. So that conference call will be able to shed a little bit more light on that.
Now, forgive me for my question, but could this possibly be a good read-through for Nike going direct to consumer?
Nike is a conundrum right now because there are so many cross currents. Cross current number one, you have the shutdowns in China. Nike manufactures predominantly all in Vietnam, so that's not really an impact. They're still working through some of those shutdowns from last year, but by and large, Nike shouldn't be terribly impacted by that.
Right.
But they will be impacted because about 20% of their sales go into China. So that's a negative. And China's been shut down. I mean, you can't sell anything there. You can't sell food in China, let alone shoes. Right. So that's going to be a negative, but everyone kind of knows that. Negative number two is just what is this weakness like in the United States? We thought things were pretty weak, especially for discretionary purchases. But then Foot Locker comes out last week and actually beats expectations. And then you have Dick's Sporting Goods today. So, it's difficult to know where Nike is going to come in on things. They did have a really good earnings report when they reported at the end of March, but the end of March was right before the consumer began to slow down. And we haven't heard hide nor tail of what Nike is doing right now. So Nike's going to be a conundrum, and that'll come out in about a month or so from now. We do have Nvidia earnings tonight. Nvidia is the large chip maker. I think it's the most valued chip maker in the world. They make graphic processing units big. They sell a lot into data center, and they sell a lot into gaming. It's about 40% data center, 40% gaming, and the remainder is kind of this professional visualization. So if you do a lot of photo or video editing, Disney would be a large customer. Netflix, those type of companies use a lot of Netflix power to do a lot of that editing. And then they do have some content in automobiles, but by and large, it's data center and gaming. And on gaming, you're going to have a negative hit just because people are buying fewer game systems and people have less money to spend on a $600-700 chip. And data center should continue to be strong. Now, it might be a little bit lumpy, but it should continue to be strong. What I would say with Nvidia is they have been supply constrained throughout the last number of months. So I do expect probably on net demand has declined if you aggregate the gaming and the data center. However, the question is, if you could have sold this many and you were only selling this many, if demand declines, can you still sell that many? So that's the big question with Nvidia. They'll report tonight. The stock has come down a lot. Expectations would seem to be fairly low because the stock has declined. Although I do think that there are a lot of hedge funds on Wall Street that are still in this name, and we haven't seen the big flush out that I think we could see in the stock. I
remember 6 months ago when we were asked, or when we were saying they were going to be the next $1 trillion company.
Yeah, now they're $400 billion.
Right.
I remember when Facebook was $1 trillion company briefly. Amazon's doing its best to get under $1 trillion too. Finally, we want to talk about the Fed minutes today. We don't have Tom here, but I'll kind of give you the quick rundown. Jay Powell has been clear that he wants clear and convincing evidence that inflation is coming down before quitting on the 50 basis point rate hikes. These are the minutes from the meeting that happened in early May. So obviously we have had a ton of data come out over the last 3 weeks, even just from companies saying that the consumer is really getting hit. We're starting to see a little bit more on the way of markdowns. I don't think the minutes are a little bit stale in that respect. I expect that we're probably going to see the path that Jay Powell laid out in the post-meeting press conference in early May, which was 3 meetings of 50 basis point rate hikes and then 3 meetings of 25 basis point rate hikes. I expect that's the path. I don't know what the market reaction function will be on that. I expect it will probably be volatile. Right now, interestingly, market participants, I'm not saying this is what should happen, but what I'm saying is the collective Wall Street consciousness is beginning to think, especially on the hedge fund front, that the Fed needs to get more aggressive, that the Fed needs to do a 100 basis point hike now, because the Fed is running the risk of just crushing the American consumer for years to come if we don't get a handle on it. And we had this debate in the PM meeting yesterday, in the portfolio manager meeting, and I think that we need the Federal Reserve rate hike probabilities to go between 12 and 14 before we get close to seeing a bottoming out here. Because right now we've kind of run up, the market's stabilized, not run up, but it's stabilized on the back of this idea that the Fed isn't going to be as aggressive. But I think in order to really see the bottom, we need the Fed to demonstrate itself to be as aggressive as it needs to be. And that'll require more rate hikes, I think, than the 10.5 or so that's priced into the markets right now. So that's my view. But I think that it's very, very much up to debate. It's a 51% view. It's not a I'm strongly convicted in that. But I think I wanted to point out that if the Fed does get more aggressive on rate and hikes, I actually think that could be good for the market, not bad for the market. Previously, we would have said that is unequivocally bad for the market. I actually think it could be good. So with that, Jonathan, thanks for hopping in today.
Thank you, Ben.
Thanks again to Logan for running all the behind the scenes. And we'll be back with you tomorrow. We'll digest the Fed minutes. We'll digest Nvidia, and then we'll set the stage for Costco, which we'll report to tomorrow evening. Thank you.
Thank you.